Come to order. Will you take the attendance card?
Chair Neely,
Here.
Representatives Farhat, Rixey,
Here.
Carter,
Here.
Witset,
Here.
Grant,
Here.
Price,
Here.
Van Workum,
Here.
Markkinen,
Here.
Outman, Tisdale,
Here.
Hoadley.
Here.
Madam Chair, you have a quorum.
Thank you. Rep. Britsy makes a motion to adopt the minutes from April the 19th, 2023 meeting. Without any objections, the minutes are adopted. Today, we will have testimony and vote on House Bill 4377 for Rep. Carter and House Bill 4378 for myself, Rep. Neely. We also have a substitute language for House Bill 4377, H1, and 4378, H1. Representative Witset makes a motion to adopt the substitute HB 4377. Mr. Clerk, take the vote.
On the motion to adopt the substitute, Chair Neely,
Yes.
Representatives Farhat,
Yes.
Rixey,
Yes.
Carter,
Yes.
Witset,
Yes.
Grant,
Oh, she ran out.
She stepped out.
Price,
Yes.
Van Workum,
Yes.
Markkinen,
Yes.
Outman,
Yes.
Tisdale,
Yes.
Hoadley.
Yes.
Madam Chair, you have 11 yeas, 0 nays, 0 pass. The substitute is adopted.
Representative Witset makes a motion to adopt substitute to HB 4378. Mr. Clerk, please take the vote.
On the motion to adopt the substitute, Chair Neely,
Yes.
Representatives Farhat,
Yes.
Rixey,
Yes.
Carter,
Yes.
Witset,
Yes.
Grant, Price,
Yes.
Van Workum. Next substitute.
Yes.
Markkinen,
Yes.
Outman,
Yes.
Tisdale,
Yes.
Hoadley.
Yes.
Madam Chair, you have 10 yeas, 0 nays, and 1 pass. The substitute is adopted.
Thank you. We will now take up House Bill 4377, H1 from Rep. Carter, and House Bill 4378, H1 from myself, Rep. Neely. I will be doing my testimony, thank you. I will be doing my testimony from here because of ankle injury, but Rep. Carter, we ask that you come around and take the, there she is. Thank you, Rep. Carter. You can start when you like.
Thank you, Madam Chair. Together, House Bills 4377 and 4378 would codify a Michigan Supreme Court ruling standardizing certain definitions of prepared foods prescribed under the Streamlined Sales and Use Tax Agreement. These bills would keep Michigan in compliance with our agreements, avoiding sanctions and further litigation, while updating certain definitions regarding prepared foods and prepackaged goods. Per the Treasury, the bills are predominantly revenue neutral, with no major changes to tax structure or cost impact. Any changes in the tax payment will be minimized as we move forward under the new definitions. I would now like to turn things over to Treasury to discuss bills further.
From Treasury, we would ask that David Metelsky from the Department of Treasurer and Amanda West, and Craig Johnson, the Executive Director from Streamlined Sales Tax and Government Board, to come and join us at the table, please. Thank you, Ms. Rep. Carter. And while they're coming up, my bill pretty much does the same thing as Rep. Carter said. We're just codifying some language on the bill, and Treasury will also give you more definitions on what it is that we will be changing.
Absolutely, yes. Good afternoon, Chairwoman and members of the committee. Thank you for inviting us to speak to these two bills.
My name is Amanda West, and I'm the Legislative Director for the Department of Treasury, and I have with me my colleague Dave Metelsky, who's scooted over there, Administrator in the Tax Policy Division of the Bureau of Tax Policy. And we are in support of House Bills 4377 and 4378. I'd like to provide a bit of background on the issue and Michigan's participation in the Streamlined Sales and Use Tax Agreement, or what I'll refer to as SUTA. SUTA provides a roadmap for states who want to simplify and modernize sales and use tax administration in order to substantially reduce the burden of tax compliance for both in-state and out-of-state businesses. It levels the playing field so that local brick-and-mortar stores and remote sellers like Amazon and Wayfair operate under the same rules and are required to collect the same tax. SUTA does not require member states to tax or exempt specific items, but rather, member states agree to adopt uniform definitions as provided by SUTA if the defined word or phrase appears in a member state's sales or use tax statute. The Michigan Constitution and the Sales and Use Tax Acts exempt food and food ingredients. However, prepared food is subject to tax. Prepared food is defined to include, among other items, food that is sold with eating utensils provided by the seller. Neither the General Sales Tax Act nor the Use Tax Act currently define when eating utensils are provided by the seller. So now a bit of history. The SUTA originally did not provide a required definition of food sold with eating utensils provided by the seller. In 2006, at the urging of business organizations, SUTA was amended to include a definition of the phrase, and Michigan adopted this definition. This standard boiled down to a presumption that sellers who do not primarily sell prepared foods are selling grocery items, regardless of whether napkins are set out, while sellers who do not primarily sell prepared foods are selling snacks or other items for immediate consumption when they make utensils available. In 2020, however, that standard was held invalid by Imagine Entertainment, Inc., et al. Versus the Department of Treasury. The court held that the rule promulgated by the department was invalid and instead applied dictionary definitions. So afterwards, the Michigan Department of Treasury worked with the Streamlined Sales Tax Governing Board and its Business Advisory Council to amend SUTA to allow Michigan to exclude prepackaged candy, bottled water, and bottled soft drinks from taxation, even if a seller's prepared food sales percentage exceeds 75% and it makes utensils available to its customers. These items carved out were the items in question in the Imagine case, and you can find details of that standard in the flowchart that we put at all of your seats. In short, the SUTA amendment allowed Michigan to amend its law to remain in compliance with SUTA, while also not disturbing to the fullest extent possible the Court of Appeals holding in Imagine. This amendment to the SUTA was approved at the Streamlined Sales Tax Governing Board meeting in October of 2021. And then that brings us to today's legislation, which will return us to compliance with the agreement after it made the changes necessary following the Imagine court ruling. Thank you again for the opportunity to speak to the bills, and we're more than happy to take questions. I'll send those over to Dave, and then we also have more information on the Streamlined Agreement more generally from Craig.
Do we have any questions? Vice Chair Van Welcome.
Thank you, Madam Chair. I think I got maybe a series of questions here, but can you break it down maybe even simpler, just what was the event that caused this? And I mean, I even saw it in your testimony. We're trying to understand this of utensils and whether you were given a utensil or whether a utensil is around you. What was it, the event that created the lawsuit? My understanding was an interpretation that Treasury did that then created this issue.
Thank you for that question. It's a good question because it is kind of a long and winding road how we got here. So there were a few predecessor cases to Imagine called MJR. Those cases never were published by the Court of Appeals, so they never became binding. How Imagine came up is they're a movie theater chain. They came to the Department of Treasury and they said, hey, we remitted sales tax to you on things like candy, prepackaged candy, bottled soft drinks, and bottled water. And they said, we did that in error. Those things, they're not taxable prepared food. Treasury denied those refund claims because under a promulgated rule, which is different than a Treasury interpretation, it has the force of law generally, which is what the court threw out in Imagine. That rule is essentially what you see here in this bill, which when I boil it down to its simple terms is if over 75% of your sales are considered prepared food, meaning heated by the seller, 2 or more ingredients combined by the seller, and you make eating utensils available to your customers, you put napkins out on a counter, that captures then all of your food sales as being prepared food. The idea is that policy-wise, that if you're over that 75% threshold, more than likely what you're doing is selling food for immediate consumption, which is generally what you think of as prepared food, right? The idea behind the way Michigan taxes food is you don't want to tax people's grocery bill, but you want to tax when they go out to eat or they go out to the movie theater. So that's the kind of policy concept behind it. And then it just kind of creates this bright line rule where if you exceed that threshold and you make utensils available to your customer, then it's going to capture all of your food sales as prepared food. Conversely, if you're under that 75% threshold, to make those things that aren't prepared food on their own, like the prepackaged candy bar, the seller would have to physically give or hand the utensil to the customer with the food for it to be considered prepared food.
Okay, thank you. And I think you kind of see that this is getting very, very technical. But I think one of the broader things maybe here is, and you even mentioned in your testimony, Wayfair and SUDA. And we're talking about SUDA, but because of the Wayfair decision, there's a question whether we need to address this with SUDA. What maybe is, I guess that's a question of whether we need to actually be doing this in the wake of Wayfair. And then 2, what would be, because of that Wayfair decision, what would be the consequences either to the state or to an organization if they were not in compliance with this now?
So I'll touch on a little bit here, but then I'm going to hand it over to Craig Johnson for a minute to talk about Streamline. But as far as Wayfair is concerned, Wayfair essentially held that if you're a state that meets certain requirements, you can require an out-of-state company to collect your tax based on their economic presence alone, right? So before that, it was physical presence. You had to have a store here, employees here. But what Wayfair held is you can't have an undue burden on interstate commerce if you're going to do that. And one of the things that they found favorable for South Dakota, who was the state litigant in that case, was that they had done all this simplification requirements and made their state's law more uniform with other states. They had free software through the certified service providers for people to file their taxes through. All of these things that come through Streamline, the court found very important and persuasive in reducing those interstate commerce burdens. So to the extent a state that's a member of Streamline continues to fall further and further out of compliance with that agreement, they start to impose more and more of an undue burden on interstate commerce, and you start coming closer and closer to a line where somebody could come along and challenge your ability to impose an economic nexus standard. But as far as sanctions, they can be across the board. They can be losing rights to vote on various things. It's hard to speak to what those might actually look like, but I'd let Craig chime in if you're interested, Representative.
I'd be glad to. So Craig Johnson, the Executive Director of Streamline Sales Tax. So, and I'll just limit it to just a question about the sanctions. So we have had states fall out of compliance. And when they do fall out of compliance, our executive committee and our governing board, which in effect our governing board is our member states because we are a self-policing organization, they determine what those sanctions are going to be with significant input from the business community. So the business community will say, look, if they're not following this provision, this is the problem it creates for us from a business perspective. Therefore, we think this would be an adequate sanction. What we have typically done is we have taken away the state's rights to vote on amendments to the agreement, so anything that changes moving forward. We've taken away their rights to vote on other states' compliance. So they in effect lose their, their voting rights that they are given by being a member of Streamline. That's what we've done to this point. Now, again, it depends on what the business community, when they will come to us and say, we think this is what's appropriate. Now, the business community does not have a vote on what the actual sanction is, but I will tell you that the state legislators that participate in Streamline, the tax administrators, take very seriously the comments that they receive from the business community, because we are about simplification, uniformity, and working together on this to find the best solutions. Our goal with the sanctions, from my perspective, is for a state to say, look, we don't want these sanctions, we want to get back into compliance and correct the compliance issues, and that's typically what has happened. I will tell you, from Wisconsin, that's where I'm originally from, the Department of Revenue in Wisconsin, we were out of compliance at one point. We had to go back to our legislature, revise the language in our statute to get back into compliance, because that was extremely important to us.
Thank you, Bowen. Thank you, Madam Chair. I just find it interesting, us here as legislators, we're dealing with a Treasury interpretation now that deals with an entity that seems to be its own governing board of, whereas us as legislators on this tax policy committee, that we're the ones actually making tax policy rather than reacting to Treasury interpretations, let alone this entity that has some kind of voting rights. But my understanding, I don't think California is involved in SUDA, maybe not even New York or the biggest states in the country. And now we're getting into constitutional questions of, of House of Representatives and senators and what states have what kind of voting rights on this organization. So I think it's a little complex, and yet when we see this solution, and then you're talking about interstate commerce, I mean, the examples presented to us aren't really talking about interstate commerce in many ways, or maybe there's another example besides a movie theater out there, but even the solution in front of us seems to even create it even more murkier or complex to what I think originally was a pretty straight line process of determining whether you had to pay taxes or not.
I don't know if there's a question there, but I could respond to some of that if you'd like, Representative. So as far as this not really being an interstate commerce issue, as I understand the history of the amendment to the Streamline Agreement that required states to have this in their law, it was actually brought forth by the National Convenience Store Association, because those are folks who had convenience stores in multiple states, and those states were all interpreting what it means to provide eating utensils by the seller in different ways. So it was causing them issues because they were having to figure out all of these different states, this patchwork of how these states were taxing this, whether or not eating utensils were provided by the seller. So it started off as an interstate commerce issue, as some folks operating in a national space. As far as complexity, I think, and I'm not going to sit here and tell you this bill doesn't look complicated, because I think it does look complicated, and it's a little bit of a thick read. But I think generally in practice, this has worked well. We had it in place from 2007 until Imagine overturned it just a few years ago. I think most businesses sat down, figured out their prepared food sales percentage, and then just went on autopilot from there. I will say as well, we're working through the Imagine decision now that it's had some time for the dust to settle, and the Imagine decision gives us 2 sentences to kind of figure out when eating utensils are provided by the seller, and it boils down to if it accompanies the food. So now we're being asked all sorts of questions we've never had to answer before about utensils being put into grocery bags and just all of these other scenarios that used to just be addressed here. But now they're all open questions that, Treasury is going to have to kind of sort through. So I don't know that removing the 75% standard, as complicated as it looks, I think in practice it created a lot of certainty and maybe worked a little better than one might think. And I think there's some complexity on the flip side of that as far as what we're going to have to do policy-wise to figure out what the Imagine decision says.
All right, thank you so much. Now we have Rep. Price.
Thank you. Thank you for bringing this before us. I think you make the case clearly that it's important for us to stay in compliance with SUDA. You talked a little bit about the benefits for the state of Michigan, and I was wondering if you would talk a little bit about how the Michigan businesses would benefit from this legislation.
You guys want me to take that one? Sure. Yeah, I am happy to do that. I can see you through this light here. The general way that Michigan businesses benefit from streamlined compliance and also, with these bills is when you are a business in Michigan and you operate in multiple states, which more and more businesses do nowadays, you have the same rules and the same standards in those other streamlined states as you do here in Michigan, right? So you're used to Michigan law, and then I know, Representative here made the point that California and New York, some of the larger states, aren't members, but aside from Illinois, all of the regional states are members, and that's Wisconsin, Minnesota, Indiana, Ohio. We can go down Kentucky, Tennessee, and those states are doing a lot of regional business. A lot of businesses here do business there. And so to the extent you're a business that sells food, if you're in Michigan or any of those other states and you have all the same standard, you don't have to go figure out how Ohio taxes food because you already know how Michigan does, so you just do the same thing there. Yep.
Rep. Britzy?
Thank you, Madam Chair. Thanks for your explanation. I think it would be helpful for me if you could back up a little bit and talk a little bit about the Wayfair decision. And, we've seen the landscape of purchasing things through the internet really dramatically change in dollar amount over the last decade, and really a lot over the last 3 years. Can you explain to me what Michigan received from internet sales prior to the Wayfair decision?
Amanda, do we have? So,
Ballpark?
My understanding that there was an impact, an immediate fiscal impact after that was somewhere in the $800 million range. So we're talking a tremendous amount of money because we were able to begin taxing those remote sellers.
There's two complexities involved there too.
Yes.
Is the timing is one of the problems. Well, problems for having accurate data that you'd like to see of the impact of Wayfair, because Wayfair was the summer of 2019, and then we all know what happened in the spring of 2020, right, which had a major impact on internet purchases. So that number is skewed. It's just hard to know how far it's skewed.
Dramatic, though.
Yeah.
Okay. So what about, can you tell me too a little bit about the SUDA organization and the states that you're mentioning that are left out? Is that because they had enacted rules and regulations requiring taxation of internet sales prior to the Wayfair decision?
I can take that for you if you'd like me to, yeah. So prior to the Wayfair decision, if you would have asked people on June 20th, the day before the Wayfair decision came out, in any one of the states, I'm a remote seller, I'm shipping products into your state, that's all I do, am I required by law to collect your tax? There's not one state that would have said, yes, you have to collect our tax. The reason was you had this outstanding Quill decision from 1992 that said, unless a seller has physical presence in the state, they can't be required to collect and remit that state's tax because of, and Dave alluded to it, the undue burdens on interstate commerce. And that was really the reason that SUDA started, was the states came together and the business community came together and said, look, we've got, from the state's perspective, we've got all these remote sales that are happening, or e-commerce is starting to grow. We're seeing a loss of revenue. And our retailers don't have a level playing field. Our in-state brick and mortar sellers have to collect tax. The internet sellers, remote sellers, don't have to collect it. At the same time, you had your in-state businesses that were also multi-state businesses because they were operating in multiple states saying, we've got 45 different states with their own sales tax law. They've all got their own rules. They've all got their own regulations. let's wipe the slate clean and start over. And if we could do that, let's take the experience that we've got from all of the legislators and the tax administrators and the business community and say, what do we think would be good policy today? What do we think the requirements should be? So that's really kind of how SUDA started to begin with, and that was kind of the reasoning for it. So as we moved forward, we operate under the premise of simplification. If you can make it simpler, make it simpler. Uniformity, meaning if you can't make something simpler, and prepared food is a perfect example. There is not a simple way necessarily to define prepared food. But if you can't make it simpler, at least make it uniform. The uniformity in and of itself is simplification and makes it easier, especially for multi-state retailers. In this post-Wayfair world, it makes it much easier for out-of-state retailers that are shipping products into the state of Michigan and trying to comply with Michigan's law. If Michigan's definition of clothing is the same as Wisconsin's definition of clothing, they then all they have to do is turn the tax flag on or off. But everything that's clothing for Michigan is clothing for Wisconsin. So that's where the uniformity becomes extremely important.
Thank you for that explanation. And could Treasury speak just a little bit again about how is this going to impact? My understanding is we're codifying this, which means we're already doing it, and we're just spelling it out and dotting our I's and crossing our T's. Could you speak a little bit to that? How's this going to impact the folks on the ground?
So it wouldn't necessarily codify what is going on today. It would codify the standard that was in place before this with some modifications. So before this, you couldn't take out candy, bottled soda, and bottled water if you're over that 75% threshold and you made utensils available. Under the Imagine decision, it's if we're now, you just throw that whole concept out the window, and the standard is if the eating utensils accompany the food or are specifically provided with it. So that's something we're kind of grappling with what that means. And then what the bill would do would be to bring back that 75% standard, but now with candy, bottled water, and bottled soda, even if you're over that 75% and you make the utensils available, those three items would remain not taxable. But it would, to the extent that Imagine would have held that, like chips or prepackaged nuts they're not going to be captured by these bills as far as the exclusion. So those items would be pulled in as taxable if a napkin or something is provided.
Okay.
Can I just add one more thing? And the reason why the candy, the bottled water, the soft drinks, why those things come out is those are all uniformly defined terms. There isn't any uniformly defined term in the Streamline Agreement or amongst the states on, what's considered chips, what's considered nuts, things like that. So that's the reason, and that's the reason that we were, as the governing board in the states and the business community coming together on this, we're willing to amend the agreement to allow this type of toggle so that Michigan could put these types of exclusions in and still then be in compliance with the agreement. It does create some differences with other states, but at least they're defined differences, and Michigan can indicate, it's still what's candy's candy, we just don't tax it no matter what.
Thank you.
Do we have any other questions? Rep. Holy.
Thank you, Madam Chair. This, a couple questions probably steered more towards Treasury. What would be the breakdown of sales tax revenue just from prepared food?
You mean all prepared food across the state?
In the
everything,
state,
or just
yes.
this? I'm not sure, but it would be a large number. Because if you're talking prepared foods, that's all restaurants, all alcohol. So it's a really large number.
I would add just the exclusion of these three items in these cases, so this small subset of sellers that we're talking about over that 75% rule. The fiscal impact of excluding the bottled water that we already incurred was close to $10 million just for those items. So we've already reduced the taxes and are not collecting that $10 million for this.
Okay, thank you. A follow-up to that would be, would Treasury absolutely consider these solutions as being airtight, meaning not open for any further interpretation from Treasury?
As far as how this bill works, that Treasury wouldn't need to do a lot of trimming around the edges, I guess, so to speak. Yeah, I mean, yeah, I could tell you before this issue became a problem with the movie theaters, I barely even knew this thing existed until that happened, because I think it was kind of working well on its own until it kind of came up in litigation.
Thank you.
Seeing there's no other questions, I want to read some cards in. We have Leah Robinson, which do not want to speak, from the Michigan Chambers of Commerce, opposing the bill. We also have Matt Breslin from National Association of Theater Owners of Michigan, do not wish to speak but oppose the bill. Also, to support the bill and wishing not to speak is Mark Griffin from Michigan Petroleum Association in Lansing. And also opposing the bill but wish not to speak is Bryant, how do you say that name? Schoaf from the Detroit Chambers. Now we will have Representative Price make a motion to report House Bill 4377 with the recommendation of substitute H1. Mr. Clerk, please take the vote.
On the motion to report, Chair Neely,
Yes.
Representatives Farhat,
Yes.
Brixey,
Yes.
Carter,
Yes.
Witset,
Yeah.
Grant,
Yes.
Price,
Yes.
Van Workum,
No.
Markkinen,
No.
Outman,
No.
Tisdale,
No.
Hoadley.
No.
Madam Chair, you have 7 yeas, 3 nays, 0 pass. HB 4377's report recommendation, substitute H1.
Rep. Price make a motion to report House Bill 4378 with recommendation with substitute H1. Mr. Clerk, please take the call.
On the motion to report, Chair Neely,
Yes.
Representatives Farhat,
Yes.
Brixey,
Yes.
Carter,
Yes.
Witset,
Yes.
Grant,
Yes.
Price,
Yes.
Van Workum,
No.
Markkinen,
No.
Outman,
No.
Tisdale,
No.
Hoadley.
No.
Madam Chair, you have 7 yeas, 3 nays, 0 pass. HB 4378's report recommendation, substitute H1.
Thank you. Seeing that there is no absent members, there is no further business before this committee. This committee stands adjourned.